Assalamualaikum and good morning. So this is for presentation for Business Finance FIN2603 and we are from group 4. So our group is contained 4 people, which is me, Nur Alafana binti Muhammad Jaafar, and my right side is Nur Syamini binti Zulkifli, and the other two is Nur Natasha and Nur Fadia Fana binti Nur Hafian. So we move to the next section, which is liquidities ratios. So what is liquidities ratios? So liquidities ratios are important because they help assess a company's ability to meet its short-term financial obligation and its overall financial health. Liquidities ratios are used by investors, creditors and lenders to help determine a company's creditworthiness, investment worthiness and risk level. So this is the importance of liquidities ratios. The first one is short-term solvency assessment. Liquidities ratios such as the current ratio and quick ratio measure a company's ability to cover its short-term liabilities using its short-term assets. A good liquidity position indicates that the company can meet obligation without financial strain. The second one is indicator of financial health. They provide insight into the company's overall financial stability. Poor liquidity may signal potential cash flow problems which could affect the operation and stakeholder confidence. The third one is investor confidence. Investors analyze liquidity ratios to assess the risk of investing in a company. Strong liquidity ratios indicate that the company can sustain operation and weather economic downturns. The last one is risk management. Liquidity ratios in businesses anticipate potential financial crises by identifying liquidity bottlenecks. Timely action can then be taken to address issues like insufficient working capital. So we move to the next point, which is current ratio. The current ratio is a financial metric used to evaluate a company's ability to pay its short-term liabilities, which is debts and obligations due within a year, using its short-term assets that can be converted to cash within a year. So the formula for current ratio is total current assets divided by total current liabilities. And after we calculate for both years, at 2022, we got 0.4967 times. And for the 2023, we got 0.5130 times. And for the formula, current ratio is which is higher is good. And the analysis for the current ratio, Aeon company Berhad shows a good performance in 2033 because of the higher ratio in the year 2033 at 0.5130 times compared to year 2022, which at 0.4967 times. So we move to the next point, which is the quick ratio. The quick ratio, also known as the asset test ratio, is a financial metric that measures a company's ability to pay its short-term liabilities using its most liquid assets. It excludes inventory and other less liquid current assets, focusing on assets that can be quickly converted to cash. So the formula for the quick ratio is current assets minus inventory divided by current liabilities. So after we calculate for both years, we got for the 2022 we got 0.1814 times, and for 2023 we got 0.1440 times. So the formula for the quick ratio is higher is good, and the analysis for the quick ratio is Aeon company Berhad shows a good performance in 2022 because of the higher ratio in the year 2022 at 0.1814 times compared to the year 2022 at 0.1440 times.
Next, we will move on to debt management ratio. Debt management ratio is very crucial to a company because it measures exactly how much of the business operations are being financed by debts instead of other sources of financing. There are 4 main importances of debt management ratio. First and foremost being enhanced creditworthiness. A company that has a low debt management ratio indicates that they are able to manage their debts efficiently, which in return enhances their creditworthiness. A company that has a high creditworthiness is more likely to attract investors to invest in their business. The next importance is reduced financial risk. This means that the company that has a low debt management ratio is less reliant on debts to operate their business. This also means that they are less likely to default on their debt obligations. The third importance is to improve profitability. This happens when a company has a low debt management ratio that indicates they are not spending too much on the borrowing costs and to repay their debt obligations. In return, they will have more resources to be reinvested and they can expand their business, which in the long run will help them to have higher profitability. The last importance, number 4, which is improved investors' returns. This means that a company that has a low debt management ratio is more likely to offer higher dividends and also increase the stock prices because they are generating more profit without taking excessive debts. Now we will move on to the calculations of debt ratio for Aeon Corporation Berhad. Debt ratio, simply put, is a financial metric that measures the proportion of a company's total debts and total assets. The formula for debt ratio is total debt divided by total assets, and if you want the results in percentage, times that by 100. Now for Aeon Corporation Berhad in the year 2022, their total debts is at 3,619,295,000 ringgit Malaysia. Divide that by their total assets at 5,426,323,000 ringgit Malaysia. We will get 0.6670 times that by 100, we will get 66.70%. As opposed to that, in the year 2023, the total debt of Aeon Corporation Berhad is 3,364,531,000 ringgit Malaysia, divide by their total assets at 5,223,543,000 ringgit Malaysia. Times 100, we will get 64.41%. As for the analysis, is that Aeon Corporation Berhad shows a better or good performance in 2023 because of their lower debt ratio at 64.41% as opposed to the year 2022 at 66.70%. This means that in 2023, Aeon Corporation Berhad is less reliant on their debts to finance their assets. Next, we will move on to the calculations of time interest earned ratio. The formula for that is earnings before interest and tax, divide that by interest. For Aeon Corporation Berhad in the year of 2022, the calculations will be 211,468,000 plus RM114,781,000. We will divide that by the interest, which is RM114,781,000. We will get the time interest earned ratio for the year 2022 is 2.8424 times. Next, as opposed to that, in the year of 2023, the calculation will be RM193,938,000 plus RM105,613,000. Divide that by the interest at RM105,613,000. So the time interest earned ratio is 2.8363 times for the year of 2023. The analysis for time interest earned ratio is Aeon Corporation Berhad shows a good performance in the year 2022 because of the higher time interest earned ratio, which is 2.8424 as compared to the year 2023 at 2.8363.
Now we are moving on to the asset management ratios or efficiency ratios. Asset management ratio or efficiency ratio are financial metrics that measure how effectively a company utilizes its asset to generate revenue. It assesses the efficiency of assets using in producing sales or income, helping stakeholders understand how well a company is managing its resources. The importance of efficiency ratio are resource utilization. Efficiency ratios help measure how well a company is using its assets, inventory and receivable. For example, inventory turnover ratio evaluates how efficiently inventory is sold and replaced. while asset turnover ratio measures how effectively assets generate the revenue. The second one is cash flow management. Efficiency ratios are essential for managing cash flow. They indicate how quickly the receivables are collected and how efficiently the payables are handled. And the third one is strategic decision making. So efficiency ratios provide data-informed decision making, such as adjusting production levels, inventory management, or credit policies. And then the last one is cost management. They identify inefficiencies in operation, helping businesses reduce unnecessary costs and streamline processes. The first type of asset management ratio is inventory turnover ratio. So it is essential for ensuring that retail inventory is well managed and not overstocked, especially for seasonal products. A high turnover ratio suggests efficient inventory management, meaning it is faster in sales, while a low ratio indicates overstocking or weak sales. So the formula for inventory turnover ratio is sales divided by inventory. Now we are moving to the calculation. As you can see behind me, for 2022, the inventory turnover ratio is 6.8394 times, and for 2023 is 7.4616 times. So based on the calculation, it shows that the inventory turnover ratio of Aeon Co. Berhad had increased from 2022 to 2023, which is from 6.8394 times to 7.4616 times. This means that the business had become more efficient in managing their inventory. Now, the second type of asset management ratio is average collection period. So it is a financial metric that measures the average numbers of days it takes for a company to collect payments from its customers after a credit sale. It provides insight into the company's credit and collection policies and efficiencies. Short average collection period shows effective credit policies and collection efforts, while long average collection period meaning that customers take longer time to pay their dues and could signal weak credit policies or inefficiencies in collection. Now, moving on to the calculation. The formula for average collection period is account receivable divided by sales times 360. As you can see, for 2022, the average collection period is 8.1350, round up to 9 days, and for 2023 is 8.5505, round up to also 9 days. Based on the calculation, it shows that the average collection period of Aeon is similar, which is 9 days. The other type of asset management ratio is total asset turnover. It measures how efficiently a company uses its total assets to generate sales. High total assets turnover means efficient use of assets to generate sales, while low total asset turnover means inefficiency in using assets or underutilization of resources. Now, as for the calculation, the formula for total assets turnover is sales divided by total assets. So for the 2022, total asset turnover is 0.7631 times, and for 2023, it is 0.7905 times. It shows that the total asset turnover of Aeon had increased. This means that the business had become more efficient in utilization. For 2022, total assets turnover is 0.7631 times, and for 2023, it is 0.7905 times. It shows that the total asset turnover of Aeon had increased. This means that the business had become more efficient in utilizing its total assets to generate the sales.
The two key profitabilities that we will be discussing today are operating profit margin (OPM) and net profit margin (NPM).
OPM reflects their profitability derived from Aeon's core operations before accounting for non-operational expenses such as tax or interest. It helps us understand how well Aeon's operational activities are contributing to each overall profits. So, this is the formula for operating profit margin, OPM, and net profit margin, NPM. An operational profit margin of 5.11% was reported in 2022, but in 2023, it fell to 4.70%. An increase in running costs, such as labor costs, rental prices, or location issues, may be the cause of the currency investment, minor decline in operational efficiency. In spite of this, we will continue to make money from all aspects of its retail business, which is a sign of operational stability. Keeping up a positive OPM in the face of outside obstacles demonstrates the maximum launch resilience and adaptability in the fully free market firms. It is clear that Aeon is not doing as well as its competitors in converting revenue into net profits. Though when we contrast their performance with the retail industry norm of 6.16%, Aeons may be able to close the performance gap by increasing income sources, improving operational efficiency, and minimizing expenses in order to meet or surpass the industry standard. Let's move on to the next key profitability, which is return on assets or ROA and return on equity or ROE. This is the formula for return on assets and return on equity. Let's focus on return on asset, which is ROA, which measures how efficiently Aeon utilized its asset to generate profit. In 2022, Aeon recorded the ROA of 2.5 after in 2 decimal places, meaning it generates 2.5 cents in net income for every 100 ringgit of assets. By 2023, this improved slightly to 2.198, showing better assets utilization and operational efficiency. This increase suggests that Aeon has made strides in effectively leveraging its resources to boost profitability. However, while the growth is encouraging, there is still potential for Aeon to further optimize its assets management strategies to achieve even higher returns. So next, I will talk about the return on equity or ROE, which measures how effectively a company generates profit from its shareholders' equity. In 2022, Aeon's ROE was 6.1555%, and in 2023, the ROE is slightly improved to 6.1770%. So basically, this reflects a small increase in Aeon's ability to generate returns from its shareholders.
Now, this is the comparison for the inventory turnover ratio in the industry for 2023 versus Aeon. As stated in the question, the industry ratio for 2023 is 7.1 times. Meanwhile, the inventory turnover ratio for Aeon in 2023 is 7.4616 times. This shows that Aeon shows a good performance compared to This shows that Aeon company shows a good performance compared to industry average. The business is efficient in managing its inventory.
Here is the comparison of Aeon Corporation Berhad's debt ratio compared to the industry average. As per given by the question, the industry average is at 75.3% for debt ratio. Meanwhile, for debt ratio of Aeon Corporation Berhad, it is at 64.41% as of the year 2023. The analysis for that is that Aeon Corporation Berhad shows a good performance compared to the industry average. This means that the business is less reliant on debts to finance its assets.
Task 2 is compare and analyze the company ratio year 2023 with the industry average. Given the industry average for net profit is 6.16%, the net profit for the year 2023 is 2.7811%. The analysis for this ratio is Aeon Core Berhad shows a bad performance compared to industry average. The business shows less profitable as compared to industry. It earns 2.78 cents net profit for RM1 ringgit sales. However, for the return on equity, given that industry average is 5.25% and the return on equity we get 6.18%. The analysis for the ROE is Aeon Co Berhad shows a bad performance compared to industry average. This shows the business is not efficient to be equity to generate income.
The next strength of Aeon Corporation Berhad is their improved debt management. This shows through their decrement of debt ratio from the year of 2022 at 66.70% to the year 2023 at 64.41%. This means that Aeon is less reliant on their debts to finance their assets in the year 2023.
So the second strength that we found is efficient inventory management. So the inventory turnover ratio increased to 7.4616 times in 2023, higher than the industry average of 7.1, indicating improved efficiency in managing the inventory.
So for the strengths for Aeon Company Berhad, I choose consistent revenue and profitability because of the revenue was stable at 4.1 billion ringgit. Net profit increased slightly to 114.8 billion ringgit, driven by cost controls and growth in property management services.
We move on to the last recommendation of strengths, which is return metrics. Return metrics is when return on assets (ROA) and return on equity (ROE) show marginal improvements from 2022, indicating enhanced assets and equity efficiency. Recommendation for the weakness is the company is below average profit margins. Aeon's net profit margin 2.78% is significantly lower than the industry average of 6.16%, highlighting lower operational efficiency. The next is declining operating profit margins. The operating profit margin dropped from 7.80% in 2022 to 7.01% in 2023, signaling rising operating costs.
And for the weakness of Aeon Company Berhad, I choose moderate time interest earn ratio because of the decline from 2.8424 in 2022 to 2.8363 in 2023 indicates slightly reduced ability to cover interest expenses.
And the last weaknesses that we found is limited growth in digital transformation. Despite improvement in Aeon's digital platform, my Aeon 2Go still faces stiff competition from other established e-commerce platforms.
There are 4 recommendations to boost shareholder value, and there is improved profit margins. Improved profit margins is when the company organizes operations and cut unnecessary costs to enhance both net and operating profit margins. Other than that, optimize supply chain processes to lower expenses and improve overall efficiency.
The second recommendation to boost the shareholder value for Aeon is digital expansion. So the Aeon company have to enhance the features and offerings of the My Aeon 2Go platform to attract more users and boost sales. They also need to merge loyalty rewards programs into the digital platform to foster customer retention and engagement.
So for my recommendation to boost shareholder value, I choose expand high margin segments because I want to focus to boost shareholder value. So the first one, we have to focus on growing the property management services segments, which reported increased occupancy rates and tenants retention in 2023. The second one is develop private label brands to improve profit margins and offer differentiated products to customers.
The next recommendation is to employ effective risk management system. For Aeon Corporation Berhad, what they can do is they can employ and use fraud detection system that utilizes AI and machine learning to detect any unusual transactions in their financial reports. And the next one is that they can also enhance their anti-money laundering system. This means
that by using the enhanced AML, they can avoid any money laundering actions that happen and that poses a threat to the company.
So the conclusion we got is, in summary, Aeon company Berhad shows some improvements in some areas of financial performance between 2022 and 2023, including better debt management, higher inventory efficiency, and slight increases in profitability metrics like net profit margin, ROA and ROE. The current ratio improved slightly, but the quick ratio declined, highlighting liquidity concerns, while the company reduced its reliance on debt and managed inventory efficiently. Its net profit margins remain significantly below the industry average, reflecting operational inefficiencies. Overall, Aeon needs to enhance liquidity, streamline costs, and boost profitability to align with industry benchmarks and strengthen its financial position.